Welcome, everyone. Welcome back to the Trend Following Traders Trading Ideologues weekly meeting. One day early due to my travel schedule to wonderful New York City. Not bad up here. Pretty fun. Weather's okay. No problem enjoying the city. I love being in New York, walking around the neighborhoods. Oh, I had a snafu in my coffee this morning, but the crisis was averted. And we started pretty much on time, but that would have been a delay. No coffee, no talking. Got a lot of good stuff to talk about today. A lot of good tweets out there today, this week. Interesting, controversial. Richard's not with us though, so that's no good. That would put a limit on our Thursday meetings if this is going to be a problem for him. So we always miss him, but no, he'll be recording, so keep that in mind. Oleg, how are you doing this morning?
Hi Jerry, hi Bruno, hi Marcel, hi Absolute, hi Jerry Smith, hi all the people I see here. I'm always happy to see you here and to be here, and I always say this. I'm in the wild nature, in the tent. I like to spend time in the tent in summer, maybe a few days. I have found strong connection in the very nice forest. So always perfect. Oh, hi Alp, by the way. Always perfect. And I started to read. I'm thinking about lots of nature in nature. I like this, and about our trading, our classical trend following. Find similarities here. And now I started to read the book about maybe startups. I don't know, in fact, about from 0 to 1. And I don't know about what this book is. I know only that it's about startups. But I want to say that I like the idea of the author that when he said that people, when the market crashes, people start only then. People start to call it a bubble. And before it, they call it a good businesses or something like that. It's about conventional wisdom. I agree that conventional wisdom almost every time is wrong. Wisdom and contrarian systems like trend following, divergent systems, they are most perfect in all fields. Divergent systems, most perfect adaptive systems. And it's very interesting how people believe in a stock, for example, or in a country, in a government, or something like that. And when that stock crashes, it's my thoughts now. When the stock crashes, or when maybe the country crashes, the people really begin to call it bubble, crisis, dictatorship, something like that. But not in the moment. And we, trend followers, we always have a clear plan what to do in almost all circumstances. And our plan is adaptive. We have mechanism of adaptiveness. So it's one of the biggest evidence that it's perfect. It's one of the biggest evidence. And about the future, I would say that I like the thought that we know only about the future. I have read this also in this book, that we know all about the future. We know only the fact that it will be looking exactly as a past. It's the only fact we know. I agree with this. So adaptiveness is very, very important, and we have it. It's our big strength.
I'm just rifling through my tweets this week. I don't really see that I tweeted anything profound yet. I guess Moritz tweeted about the orange juice, and that's a pretty good trend. It's always helpful to sort of go over these trends and make examples of some of them. You know, any one example is not can't be used for a good rule, but it is nice to see something like that. Oh, and I haven't checked OJ this morning. It could be down a lot, but I think that's a really good trade to see every now and then where you get these big trends. And I guess it was a fair amount of choppiness that would have caused you to get out with on a system that had a closer stop. But that's what's going on with me. Mostly the OJ, sugar, and cocoa is still pretty strong. Cattle, feeder cattle, pretty good. But it's been pretty quiet. Obviously, I did notice that my stocks are kind of not doing too much, and it's kind of interesting. I think I did too good of a job on the diversification of my stocks because I don't usually do as well on the up days as the S&P does. So that's kind of the intent, that these stocks would be different and they would have some diversification. And of course, I have a fair amount of shorts, and seems these days I'm adding shorts as much as the longs are getting hit. The shorts are getting hit on some days even more. So
Which says always very, 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 very wonderful things about nonlinearity. And really, I think a lot. I like to listen to Rich in podcasts, in interview with Niels, and I like this approach. I like this approach that the science-based, deep approach of our 24-hour philosophy. I really like this. So, and we have an unlimited upside and limited downside, and we have this non-linearity, and which often says about this, and it's very, very deep and interesting things. Very, very deep. And listening to each, I understand how deep our philosophy is, and but also I like to find evidence of our 24 prints, as you know, I think, evidence of our 24 principles in nature, and I often found it, or maybe in different fields of human behavior, human. I see this. I see this. So it's really very interesting to listen to read Jerry. It's very, really, very important and very valuable for me.
Hi guys, how are you? I just wanted to ask you, Jerry, about these days there's been a lot of issues going on here in Argentina, and I was half joking about what that you guys should put the Argentine peso in your portfolios since you have lots of instruments. But the real thing is that it's mostly impossible to trade it because it's very small, very liquid, and very intervened. So I was wondering when you go, to trade more than 100, 200, 300, do you have any different kind of view regarding liquidity or counterparty risk? So you can put more contracts, or you just keep going, in the same well-known future exchanges? Because, for example, I was talking with Moritz that there's no good futures exchange for the Argentine peso, but then there is the non-derivable future or forwards against banks. Would you do something like an NDF against a bank in your if you want to add more contracts?
yes, and I do that. So we do trade a few of those non-deliverable forwards, but it has to be liquid, and the counterparties are as interested as we are in making sure that it's going to be a market that's stable and not crazy, and and that it's liquid enough to trade. We took Russian ruble off, Turkish lira off recently because I think those markets got a little untradeable. And I've noticed over the years that brokers take the lira on and off over time. But for me, it got a little scary when the ATR got too low. That's what I don't. That's what is. I think that's a problem when the market just gets so quiet and nothing's really happening, and probably a sign of a lot of government manipulation. And my point on posting that chart is that I think you have to look at the futures chart or the forward market in some of these less liquid currencies, and they look much different than the cash chart. So when we do a forward contract, we will incorporate the futures data as a more real, because we're essentially rolling it out to the IMM date, or 3 months out. Usually, when we every 3 months we roll it, so it's really not a situation where you can get those type of profits as an investor and a trader. But yeah, we trade all of those. I don't remember which ones are non-deliverable, but so far it hasn't really impacted our trading. There's been no problems or issues. And then you sort of say, well, now this is my not something to ignore by any means, and this is not an excuse or something to take refuge in. But I have traded enough, and you don't even have to trade enough to see crazy things happen in the world's most liquid markets. We saw that in the proverbial Swiss franc trade a few years ago, and then, oh yeah, I've been around where there's been so much dislocation. I mean, there was a day back in the 90s, I can't remember exactly, where the Bank of England cut rates in the morning and raised them in the afternoon, or vice versa. So it was a crazy period where some of the most liquid markets in the world were not liquid. So it can always happen. And that type of move that you saw in the Argentine peso was not unique to NDFs or markets that are usually not that liquid. It can happen anywhere. Small bet size, that's what Richard put into my vocabulary, how important small bet size is, because even with markets that are correlated, sometimes one of them will really, really misbehave and cause big problems when the other ones don't. Now, if everything goes against you in a sector or a part of the portfolio, then that's another type of a problem as well.
I remember, by the way, I want to say that this small bet size is it's a very big key to success, because I remember that 8 years ago, one trader, he worked in an office in Russia, and he asked me, he said to me that he has a big problem, that he is very stressed when he's trading, and he don't know, he has had no rule for the stress, for environment, what to do with the stress, how to deal with the stress, and he talked much about the stress and about the road and something like that, about fundamentals and all of the stuff. And I said, your bet sizing is too big. This is the key. You trade too large. This is the key component of your stressful trading. And he said, yes, it's really so. I trade too large. And the problem was only this. There was a source of a stressful trading activity of this guy. So it's very important, very, very important. Be diversified with the small bets.
Hi guys, can you hear me?
Yes.
Um, so the main thing in my portfolio is with the stocks. I've got 70 stocks. I guess I've got three outliers that I'm running so far. One of them is a very much a classic US brand. It's called Tupperware. I'm running that Tupperware. I picked it up without knowing what Tupperware is into my fixed portfolio. I just didn't know nothing. Risking 20 basis points, so not a lot of risk associated with it. So I bought this stock from $1. And after I bought it, the stock has gone from $1 to $2 to $3 to $4 to $5 to more than $6 in 2 to 3 weeks, basically. All right. And thanks to this August pullback, now the same stock has come down from $6 to $2.50, and that's the kind of volatility that you probably would observe as part of single name stocks trading. You know, um, so it was very interesting couple of days. So I might just exit the position. My system, might just exit it, but it's very volatile. Some of the stocks I would say they're liquid, so I'm not worried about that. It's not a big position anyhow, very small position, but it's when you make 6 times of what you're risking, it becomes immediately like a big outlier in the portfolio. So it's very interesting. And now the stocks are coming down. Of course, I've tweeted it yesterday. Everything else in the portfolio is working. You know, the bonds are short. Wow, you know, all bonds triggered short signal in my short-term portfolio. Bang, bang, bang. All of them started to trigger the short signal, and then USD USC started to go long, and I followed those signals with a huge lackluster interest. Because I do have this opinion that USD must go down. USD must break that $100 and come down, but you know, it's not happening. So I'm wrong. So my opinion is wrong. So my opinion doesn't work much, but I'm not following it anyhow. But it's psychologically it is difficult. When I'm just stop following up my opinion and just following up the system, is there's a tension there. I feel that tension. It's just there, but I'm following the system anyhow. But so the USC is long, bonds are short. For some time, energy long trades are there. These crudes, the brands, the oils are going well, and of course the metals, right? The silver's short, the gold short, the metals short. So that's there as well. The precious metals, the basic metals. So it's quite diversified, and in the last couple of maybe in a week or two, I say since US has been downgraded on the 1st of August, volatility have increased. My positions started to get reversed. This stock market. I did have some nice outliers. Some of them exited, or I'm still running it. They're about to exit, like Tupperware. From $1 to $6, I'm back to $2 again. So it's very volatile month, August. But the portfolio is not moving much. So my balance is not moving much. Thanks to trend following, it's so diversified. The money that I'm losing on the single name stocks is being compensated with the rest of the portfolio, and that's why this is such a good balanced portfolio with a huge downside risk protection. The entire portfolio has been designed to work, um, and to do it better in exactly in the circumstances like this. You know, U.S. credit ratings downgraded. The U.S. market was in a bull market. We are going through a pullback. We don't know how far the stock market is going to go back. But now I know that because I'm short the bonds, I'm short some of the commodities. I'm long the dollar. I'm comfortable. So yeah, bring it on. I say bring it on. Let's see what happens. Thank you.
Hey, hi everyone. Glad to be here. I've been off a couple of weeks now, and well, anyway, uh, I've been testing on some alternative markets and try to verify if that statement uh, by Doug is true. If alternative markets are better for trend following, and what I find is that, well, first of all, it's hard to make that statement. First, because you don't have much data, you don't have much history on these alternative markets. So it's hard to say if it's a couple of outliers you're seeing or if that's the rule. When you compare, for example, with the Treasury's futures history of over 50 years of data. And well, but anyway, what I find is that it's not that much of a difference. Perhaps a little better, but can't make that statement not on based on the data I was able to get. And it's just amazing how trend following systems are a machine of chewing data and spit every time that about 40% hit rate, about 3-1 win to lose, wherever you look. So I try to look first at these alternative futures. It's mostly energies, some of those Chinese futures also. And I got these results that boost my confidence on the systems I do run, on the markets I do trade. And it's like a tap on my own back that the systems I'm running are okay. And then I turn to Brazilian stocks, and that's what I'm researching right now. And again, 40%, about 40% hit rate, about 3-1 win to lose, not much different from that. You've got a couple of different statistics every now and then, but I suspect I must get harder on my data, get tougher on it, because I may be overfitting something, because these results I got first when I look at the stocks that are currently trading. Nothing about the history of dead companies in the history of Brazilian markets, and I should want that. But the other lesson here is get cautious with your data, everyone. It's hard to get it. It's expensive as well. It costs time to have good data. But anyway, the message I wanted to get to you guys is that it doesn't really matter what you're doing and what you're trading. You're about to get that 40% hit rate, 3-1 win to lose, and that amazes me every time.
And I have said before that alternative markets, they're good diversifiers. I believe that, and I had a research on this topic. But I think we can't. It's not a good idea to trade only alternative markets because it can be too much surprises with this liquidity, and not only with liquidity. We don't know the future. And this is our whole philosophy based on this, that we don't know the future, what the future will bring to us. And of course, we, like as Jerry said, that NVIDIA had rally. And I remember Tesla had rally, and very, very traditional markets, very big markets, the biggest markets in the world, uh, currencies, commodities. The biggest markets in the world have very tremendous big rallies. And
Oleg, a real quick question. What do you use for look back on the diversifiers? Is it 3 months? Is it 1 year?
Well, one of the things, it's good to hear, Bruno, because obviously I believe in that as well, that all these markets should have the same expectation. And, it depends on when you test as well. Right before the commodities took off in 2020, we may have had a lost decade in the commodities, or in the grains in particular. I remember looking at research reports over the years and being just horrified at the lack of profits in the soybeans and some of those, and wheat and corn over the years. So you just have to keep these markets in there, keep trading them, and a lot of it just is going to depend upon the trends. Cocoa, prime example, but I think it's quite a bit different worldview to look at these markets individually, think they have a personality, look at their own individual Sharpe ratio. I hear people talk about that a lot. And I get a lot of, I don't it's probably just coincidental because no one is like harassing me too much. There is a little bit of harassment on trading stocks, and I see these tweets. Trend following stocks doesn't work, and you just don't know what systems they're using. It's a struggle for some people to get 40%, get up as high as 40% winning trades. I have no idea why that should be a struggle. And so people just do back tests differently. And the world thinks of the stocks as the S&P index and all these indexes. And so, but yeah, I'm pretty bombarded almost daily about trend following stocks doesn't work. And there's just so much going into that about how the data and the stocks you choose and how you trade them. So I'm particularly, and then once again, I was on this podcast and okay. So first of all, I posted this Twitter and it's the pinned tweet of mine. And it says risk-adjusted returns are the most deceptive, disingenuous words in all of investing. I just saw a typo. Thanks. Okay, so that I got from an article Spitznagel was in, and he is kind of a funny guy, and he likes to put out really crazy quotes, and I thought that was pretty humorous. And now, and I kind of agree with that. Obviously, I have it pinned. So I think what he is saying, or what I believe to be true, is that when people say risk-adjusted returns, they are up to no good. And he goes on to say it's meant to almost distract from the only thing that ultimately matters, maximizing wealth over time. Right, because they're talking about Sharp, and they're talking about their favorite volatility, using volatility to measure return and risk. And of course, I don't agree with that. And it is kind of a marketing tool. Like, this is how I've created my system. It has lots of vol management, correlation management. You need to look at risk-adjusted returns, and they're up to no good. Now, if Richard said risk-adjusted returns, and he would look at that in a way I would probably agree with, but it's coming from Richard. So for most people, though, they're coming from a place where they just don't agree with us. They don't agree fundamentally, or they just can't imagine how it could possibly be true that you don't use Sharp or some sort of vol. However, I was on this podcast, and I haven't listened to it, and who knows, I may have said that without any explanation that risk-adjusted returns are deceptive, disingenuous, or whatever, without explaining that obviously you've got to use some risk measurement. You've got to use something. And I have, especially like last week, probably, I went off on this, and I was making fun of people who they think that, well, in order to measure performance of a manager, a CTA, or any sort of trader, they're just going to look at what the performance table says. And I think that's kind of silly. Like, could it be possible that there's something deeper that you should look at, which you have no access to? Granted, I get it. You have no access to it. That doesn't make it right that you should use only what you have access to. Now, obviously, in this group, you could ask a lot of questions. One entry, one exit, and stop loss, lots of diversification, small bet size, blah, blah, blah. And you could say, okay, that makes me feel more comfortable, even though all I see from them as well is the performance table. And of course, I like the trade stats, the win-loss ratio, the average trade, winning percentage, things like that. And also, I like internally what I look at are the closed trade drawdowns and things like that, which is not available, which could be available if people thought it was going to help them raise money. Here you have these big firms that have billions of dollars under management, have all kind of capability. If you gave them one hint, oh, here's another way you can raise money, they'd put 15 people on it, and they'd have that information out today. So, but they don't, because they don't care, and they want to continue to use that Sharp and vol measurements. So I didn't want to come, and she kind of posted in another tweet that I didn't care about risk-adjusted returns, which is not really true, in that because you can have just this absolute return out there, without some sort of measurement of risk to your capital, from my point of view. And it's difficult to get at that information. Plus, most people don't agree with that you need to look at all the AUM. Why aren't you concerned with all the AUM? Well, I've answered that many times, and I'll have to answer it again, I'm sure. So, but I don't want to be on record as not, and I don't really understand. I wouldn't like to say the words maximizing wealth over time, absolute return, these sort of things, without also including in that sentence or the sentences after that how I would measure risk. Right. I was trying to explain to someone on Twitter or in a direct message that I have two funds, and one trades twice as large as the other. It's virtually the same trading, except one is 2x. So they're the same systems, the same markets, the same positions. So if one does a lot better, obviously, and it can do a lot worse, of course, but in a period where the one that trades twice as large as the other does a lot better, I don't deserve credit for that. I don't deserve, you're really a good manager on that one, but you're kind of so-so on the other one. No, you're just your choice of leverage and the clients you're targeting or the group of people that are interested in lower vol or higher vol.
I like all this, and I want to say that I like the idea of Richard that it cannot be a good in non-linear world. Any any measurement like sharp is not good because sharp is a linear-based measurement of risk. So it's not correct. And of course, I understand that. I agree with Jerry that people use this as a marketing tool, and their clients. They want their clients to think that all is under control because of this linear measurement. Because people think that the road is less crazy and the road is very stable. Maybe I don't think. I think they say something that people want to hear, and so they raise more assets under management. But of course, there must be. It's better to educate people, and some of them maybe will be your clients to educate in the right way, do the right way, do the right thing, do the hard thing, and it's. I think it's better to educate in such a way than to don't tell not tell the truth about the markets, about the road. I think so. First,
It's not that it's wrong per se. It's just that it measures something that we're not really interested in measuring. And under some conditions, you can say that volatility is risk. And if you have a really volatile portfolio and you cannot endure any drawdown larger than, say, 5%, in that case, volatility can be viewed as risk for whatever reason. You cannot endure that mandate, or your clients didn't sign up for any drawdown larger than that, whatever. And under that circumstance, you can say that volatility is risk. So under that case, you're striving for a high sharp simply because you cannot endure that volatility. Perhaps the lesson for us here is that we should educate, just like Oleg was suggesting, and that for us, the volatility is not the same as risk. I know Jared does a really good job trying to do that, saying all the things about closed equity versus open equity, that the volatility is only on the open equity, and I do think that's the way to do it, and that's the way to educate people. There are valuable lessons there, but I don't know. And the other thing is that Sharp does a nice job when you're comparing different strategies. So for an investor to decide, it's useful to have a rule where you can compare everything. Unfortunately, that rule is not that much. Doesn't bring all the good aspects of the trend following, but that's how it is.
See, there you go. This just goes to show you that Bruno can't get an A+ on every class. So he, I was following you for a while there until, and I was going to agree, and I do agree that volatility can matter. For instance, if you, it can presage the destruction of closed trade equity, of realized equity. So if you have on a bunch of brand new positions and you're getting ready to take a lot of losses across the board, I've been in a situation like that where we literally, I forgot it was '08 or '09, where we literally got down to so few positions we'd ever seen before. We have a flat, we were long, short, and flat. So we were just flat almost the whole portfolio. And then when you start throwing those trades on, eventually, then you could come into a situation where vol picks up. You haven't increased your trade level, obviously never with the open trade profit, but you can get into a situation that like with 2 more days like this, we're going to have a closed equity drawdown, and we're not going to have any open trade equity to speak of to buffet that. So that can definitely happen, and anything can happen. That's my whole point. Anything can happen. History's not a good guide, pro or con. It's going to be a lot worse than the back test in the future. But I don't have any sympathy. No sympathy. No, at all for, volatility impacts me, so I'm going to use Sharp. Look, don't trade, okay? Just that's an option, You can trade or not trade. I have a personality where I'm going to do things that people are telling me are incorrect. Intellectually, I can't deny, or I'm not willing to debate or argue against it. But I'm going to do it because it makes me feel better, and I can't trade if I don't monitor vol. Then my suggestion is don't trade. Don't ever use your human weaknesses as an excuse to trade a suboptimal strategy. I would not do that. But I hear this. Obviously, I hear that a lot. You've got to have a system that you can trade, that you'll do the trades so that you can. If you're not paying attention to volatility, you may give up on the system. So it's no good if you can't do it. Yeah, well, then don't trade. Essentially, trade a robust one entry, one exit stop loss system, and lower the leverage. That's the discretionary call that is acceptable at all times, to trade smaller with a good system, but not on purpose ignore reality and facts. But it's okay to choose that other way of trading as well, if you believe in that, I guess.
I like this very much, and I remember how in November 2021, near 2 years ago, I remember Jerry said that if people think that there are no right way, that they can. He had very good example, very funny example, with the builders of a big houses, maybe skyscrapers, and if they will say we don't have any perfect decision, we don't have any perfect way. Each of us have our own opinion, and after all this debates, this skyscraper will be crashed because they don't have right opinion or perfect decision or something like that. And it was very great, and it was sound funny, but it was very great because we must have our core principles. Of course, we can be different. We can have different some details, maybe different, but we must have our core principles, and we must follow our principles and our rules, and that makes us systematic. That makes us trend followers, and these principles, they are based on our great philosophy. So, and of course, we're talking about modern modern tools of this advertisement, of marketing tools. Yes, a lot of this measurement used as a marketing tools, but we must understand, and we must educate people, as I have said a few minutes ago. We must educate people as much as we can, I think. And in the long run, will pay out. Be it will be a good job, perfect job, if I sure. Of course, not all the people will keep being our clients. Not all people, maybe even like Jerry said, that only 1% of the population like potentially our approach, but it's we can raise good money, and if we will be more, if we will educate more, I think 1% is not. It's it's not it's a good. It can be good assets under management, even with 1% of the population. I think so.
Jerry, can I ask you something? You are going to the way of having 300 contracts, etc. But talking about risk, etc. What do you think about the quote of Paul Tudor Jones? You know, where he basically says that it's great to put a moving average to anything. You know, like if you're trading a single thing, if you do it with a moving average, and I guess with any kind of trend following device, it's much better. Do you think that applies, or is it diversification a must?
Who said that?
Paul Tudor Jones.
Oh, well, yeah, I like him a lot, and he is. I have heard him say that, and I heard him say it in person once, right after the Great Financial Crisis. He was in Charlottesville, Virginia. He spoke there with Julian Robertson and Griffin and Lee Ainsley, and it was a fascinating talk. And he's very adamant about 200-day moving average. But well, you threw me a curveball there at the end, I think, which is, or do I think diversification is enough? I think that's what you
No,
said.
no. If it's a must, I mean, you know, I was listening to Bruno, you know, talking about Brazilian stocks, and you know, I have my experience on Argentine assets myself, and I remember in the '90s, the guy who was our mentor, he was doing trend following, you know, but very, but not diversified at all, and you know, he had great results, of course, in a time when things were very, very cheap here and there was no information in anything. For example, there were Peruvian silver mines trading for less than the cost of their power generators, right? So it was a great time to buy cheap assets. But I remember he was a great trend follower by nature. I remember he had a pair of scissors in his trading desk to remember that he had to cut, you know, things that were against him. And one time he went to in the '90s, in the beginning of the '90s, he went to see Bill Eckhart because you know he received the monthly trading magazines with 2 or 3 months of delay, but there was the telephone number of those guys there. So he called them and he arranged a meeting and he went to explain what he did. We was basically doing trend following inside Latin America, inside Argentina, and Bill listened to him and said, you know, you just got luck because you're not diversified and your business will stop working in the future. And that's what happened in the end. So I was wondering if you think which one of the positions you're most comfortable with. The one that says, you got to diversify. If not, you're just playing luck, or having a 200 days moving average is great for even a single position.
Well, I think you got to diversify. I don't think it's luck, though. I think that because I've traded 20 some markets before, and it's just a situation where it's going to be bumpy. You're not going to have as much smoothness. The more markets you trade, you're going to have more winning periods probably. But Paul, the 13 Fs came out. People are writing stories about 13 Fs and the positions that some of the big hedge funds have. And one of them that was in the news this week was Paul Jones and maybe Greenlight having these positions that they started buying REITs, real estate investment trusts that were heavily into New York office buildings. And so then I pulled up the charts on these, and they had rallied quite a bit off the lows. So good trade, right? So I was like, okay, that's good. So you're looking at these things now that they rally. I didn't put a moving average on it or anything, but it was not quite up to my breakout level to buy, which doesn't mean anything because they're not in my portfolio. But I just thought that was kind of interesting that, and who knows, they could have bought them, tried to buy them near the lows. I didn't do a lot of research, but I do think you bring up a very good point, and that is, I think that if I don't think it's a good idea. Well, I mean, some of these guys have ways of making money that I don't know anything about. And they just have an edge, let's say. I guess it's possible, right? We see them where a lot of these big traders, macro traders, they're successful for a long period of time, and then they're unsuccessful and dramatically unsuccessful. So, but anyways, let's just assume that there are people out there who are deriving their profits in the markets and have for many, many years, primarily not trend following or not trend following at all. Now, that's something I just don't know anything about. And if they were to say, well, what do you think about an overlay of trend? So I have all these great ideas, but I do take big losses sometimes. I do get out too quickly. I get in too quickly. What do you think about this? And I'd say, I'm not really sure. But I do know that if you start from a trend following point of view, and that is going to be your main way of creating this edge, then I don't think that it would be a good idea to add other factors beyond the trend, because you're getting into a situation where you're no longer rules trading, and the results you saw in the back test on this particular moving average that you chose are not that relevant, because now you're making decisions and trading decisions not just based upon the trend system, the moving averages or the breakouts. So I've said many times that trend following is just jealous. It's very jealous because it doesn't want you to use anything but trend following. So I don't think you can I could not rely upon my results if I used other things. So then it becomes, well, what about the opposite? They primarily don't use trend following, but they want this trend overlay. I'm skeptical. All I can say is I wouldn't think that it would work, but I don't know anything other than trend really. And how do they consistently get an edge in the markets taking long-term positions without using trend? So I wouldn't think that would work either, but maybe it does for some people. But once you make up your mind to use a systematic approach, I'm pretty sure that trading a lot of markets is going to work out pretty well. And there's no cost of over diversification, not in a betting system like trend following.
I fully agree, and I love trend following for that also, that long-term trend following classical system do not need anything else. It cannot be improved by anything else, at least. So there is no sense to add anything else like mineral routing elements or something like that. If we are talking about short-term transform system, I think short-term is not classical. So it can be in the short term some bells and whistles and so on and so forth. But I have a lot of questions for that also because I don't know effectiveness of this short-term approach of this bells and whistles in a long. I had a lot of research, tons of research for the years, but I don't know exactly the effectiveness of this in a long-term horizon. And if we are talking about classical long-term trend following, I'm 100% confident, sure that classical trend following system will work in many, not decades, but centuries. I'm sure that because we have very strong principles that based on, as I have said before many times, that our principles based on the laws of nature, and they see it everywhere, how it works. So I'm absolutely sure that classical trend following, diversified portfolio with proper risk management will work even maybe in 1,000 years from now. So it's very perfect.
Back to Cordura's question. If trading just a handful of markets is bad as compared to more markets, yeah, I think it's worse. But we get we get back again at that same expectation for every trade statement. Because we do have the same expectation for every trade, it's pretty much that you're playing the same dice every time you put a trade on. So that dice can come up a 1, that dice can come up a 6. If you have only 2 dice in your hand, you're setting yourself up to the risk that both of them can come up to a 1 in your bag. But if you're rolling hundreds of dice, all of them coming a 1, it's pretty unlikely. It all ties down to that other statement from Jerry that it gets bumpier, but it's not exactly or not necessarily bad. You just have to pay more attention to the risk you're running. I mean the position size for each trade, and understand that because you're probably running a larger position for each trade, and perhaps you're putting yourself on a position that you're running a risk that you cannot tolerate. But other than that, it's pretty much the same thing. I like to think that you can either you're going to do your hundreds of trades at some point in time. If you're trading hundreds of systems, that length of time can be pretty quick. On the other hand, if you're trading a handful of markets, the hundreds of trade will come along only after a longer window of time.
Yeah, I think that the way that they said it back in the day was, if you have a negative game where you're going to eventually lose because the odds are against you, go into Vegas, put all your money down on one bet, and then walk away. You want to, you eventually lose the longer you play. And in this game, you eventually win the longer you play. So spread it out, trade small, preserve your capital, because it just takes time before your edge will play out. And so the fewer markets you trade might play havoc with that. The larger you trade, of course. And then back in the day, we were trading 20-some markets and making 200% a year with this incredible volatility. So that was a dangerous game, and we survived.
Out of curiosity, Jerry.
What was the average duration? What was the average duration of your trades back in the day?
Oh, can you say that again?
Uh, I mean, um, so you were talking about, your turtle days, and I was curious about your average duration of your trades so that I can compare with mine, if you don't mind. So, when you were trading 20 plus markets, as part of the original turtle group, what was the average trade duration? How many days you were holding those trades on average?
Yeah, I I don't remember that data, but now my average holding period is over a year. So we were getting out at the 10-day low or the 20-day low. So it was pretty short term. Um, so holding periods was a lot less. I like I prefer. I've done some research on those type of systems. The daily bars and short-term daily bar system, and I don't think they work very well. But conceptually, I do like Alps hourly bar trading. I think that, on the other hand, may work a lot better. So, um, yeah, but I don't specifically remember. We abandoned those systems in the late '90s, the short-term systems. I was thinking the other day, I've had these research people over the years, and they all added something. They all had this insights that they told me about, philosophical insights, and every one of them helped me along my trading journey, primarily because of what we were able to uncover philosophically from the back test. And I remember this first research guy. He told me so I started Chesapeake in 1988. He told me probably hired him in 88 or 89. And he told me yeah, I don't think this 10-day low exit, 20-day low exit, I don't think that works very well. And I was like, what? So that was kind of a shocker. I never forgot that, and it always bothered me. Then we eventually just abandoned it. But I don't remember the average holding period.
What was
But
what was the volatility like, Jerry, back in the day? I mean, a regular loss for a day on P&L terms, any percentage, I don't know.
well, it was yeah. Well, I know I was up. Like I said, I was up 200% one day. I came in, I was up 200% for the year, and then I lost 60% of my original capital. So,
In one
like in
day?
one day,
Wow.
So we had like a 30% drawdown in one day from peak. We just had on monster positions. They were all going great. And probably the 200% was made by February or March. It was 86, I think. And we had on some great positions in short crude and probably some other markets. Obviously, were trending pretty well. But our initial risk putting on a trade would be, let's say, if it was very highly likely that crude, heating oil, unleaded could all go on the same day. And if you if you put those on and you took a small loss shortly thereafter, you could probably lose between 5 and 10%. So yeah, it was a kind of a crazy period, but that was the name of the game. It was not. It was to extract money from the markets and to become very wealthy, and not, and then this sort of cut back of your equity. And if you get into these big drawdowns, then there was no really playing between open trade equity and closed trade equity, because with short-term systems, the open trade, the closed trade, or you got on these positions and you're going to get out so quickly if it's a profit that it's going to turn into closed trade equity very quickly. So the play between open trade equity and closed trade equity and total equity, that was something we kind of uncovered, started paying more attention to later when we were trading longer term. And now if the small loss with 300 markets is 15 basis points. You would attempt to do 15 basis points, something like that. I've got to be very careful. I'm getting a lot of pushback from compliance on what I say on some of these podcasts and on spaces. So I'm not going to mention any of the funds we manage by name or anymore. Just got to talk about hypothetical strategies, hypothetical. Oh, I probably shouldn't have mentioned OJ. Just hypothetical stuff that's going on.
Hey, everybody. It's good to be here always. Jerry, I was curious, what was it like trading back then with no computers? Could you see the price at the moment, or did you have to wait till the next day? Just that sort of thing. That'd be interesting to hear about.
Well, we had a quote machine, and I shared a quote. Everyone shared a quote machine. So we had two desks put together, quote machine in the middle. We had a chart book, and we just penciled in each day's high-low close. It was great. I mean, 20-some markets, 7:30 to 3 o'clock every day, and following those rules. And we knew we had the greatest job in the world. I mean, real time. I would walk up and down the halls going to going to get a Coke or something, and say to my friends, I would say, we have the greatest job in the world, right? And they'd say, yeah, we do. So we were, but it was a lot of fun trading. It was a very only pressure in that we were greedy. We didn't want to have drawdowns, but the atmosphere was like no pressure. It's no pressure because all you have to do is follow the rules. Don't worry about losing money necessarily, because we've given you all the tools. Just follow the rules. But half the people, it took them a while, including me, to sort of follow the rules. But it was a great environment. It was fantastic. And then the biggest, untold story about the turtles is just what geniuses Rich and Bill were. And they were way ahead of their time with the math and the computers. And Rich had real pit trading experience. And so a lot of some of the rules were sprinkled in with, hey, this is the rule that people who only knew computers and only knew math would give you, but we're going to sprinkle in a few rules based upon what actually happens, sorry, down in the pits. And so it was a great period and a lot of fun. And I think, I should have, well, it lasted 4 years. It was originally planned to be 5 years, but they shut it down after 4. And I mean, I would say like every year, the group was making 200% a year. So it was nothing except they just kind of probably got tired of it a little bit and putting up with us and dealing with us. And then, but if I could have, my career would have gone much better if I would have stayed there longer, had those longer. I was thinking the other day too that one of the other lessons I picked up, I think I agree with this, is everyone should always have a mentor. I mean, all the time, just have someone older and smarter than you. Okay, so that I'm getting up there where pretty soon it may be difficult to find someone older. So you have to revert to smarter, and maybe smarter and a bit younger, but definitely someone who who maybe is a bit different. So either stay there with Rich and Bill and the Turtles for another 5 or 10 more years. Well, that wasn't going to happen. Or like everyone just assumed, well, we had all we needed, and that was like probably not true. We needed more broadening of our experience and philosophy. So I should have said and realized that I was very qualified maybe more qualified than most to continue trading futures, but maybe I had more to learn. And so I should have gotten on a plane, moved to New York, and tried to work for a hedge fund or something and learn more and think about incorporating equities uh, and getting in and sort of thinking a strategy of, oh, I know what I want to do. I'm going to trade a lot of equities, a lot of currencies, commodities, interest rates. I'm going to go learn how all this stuff works from other people's point of view. I'm not going to lose what I learned. I'm going to see if I can add anything to it from other smart people who are not from Chicago, don't trend follow necessarily, and just try to get to where broaden my knowledge and experience and combine the trend following with, for me, probably stocks. Obviously, I trade a lot of stocks. I love these stocks, but would have been nice to have all the more knowledge about stocks earlier in my career and create some sort of macro trend hedge fund. And what was really difficult for me, though, was I knew early on when I started my firm that I should get out of managed futures. Managed futures was not where you wanted to be. It was limiting, and it was not a good spot to be for many different reasons. And so it's just important to expand beyond the futures, and it took me a long time to do that. But not being a managed futures person, even today, I've got this great portfolio, all of these stocks. They're not that correlated to anything else, and I still like. If my performance is different, I'm very happy, right? But if my performance is different and worse, because I continue and everybody else probably continues to compare me to managed futures traders, I'm like, well, what's going on here? So I've even created this unique strategy that I don't know if anyone is even close to what we do. But I still can't break off from my brain telling me, I'm still like managed futures, and you have to have good performance relative to managed futures, which is difficult. I'm kind of trapped mentally sometimes into, but yeah, so I think that was my sort of history and how I kind of could have done better by getting more experience, more mentors, getting into stocks earlier, learning from maybe hedge funds or trying to get in to people who are doing different types of things. I listened to that guy from Florin Court who trades 500 markets, and they kind of brag that none of them are the big European and American markets. Nothing exchange traded, no sugar, no cocoa, just these alternative markets. And not only 500 markets, not only an alternative, but none of the wheat, corn, and beans and things like that. And when I hear him talk, he's got the trend following piece, but I hear many, many years of experience doing other types of things and being able to figure out how to go out and get those markets. And so that's what I'm missing. I don't have those experiences and those great other things I could have picked up. Go to New York, try to find the Richard Dennis of stocks or big hedge fund, get in there, learn more mentoring. You can just never get enough. You need to have these mentors for the rest of your life.
Jerry, you say this, but I mean, in terms of this Florin Court, um, their infamous Mar ratio of 2.0, I mean, is there any reality to it? I mean, is your team, because you're running a team with, you've got a, research associate and whatnot. So have you tested any of those markets that they are talking about? Is it is it possible to get closer if you test if you test those markets that they are talking about, those credit markets, the mortgage-backed securities, swaps, total return swaps, CDSs, emerging markets, not G3. Is there any chance that this MAR ratio would significantly increase between developed countries versus the other countries, the alternative markets? Thank you.
Yeah, I'm having a hard time hearing you, but um, I think for some people it turns them off. Clients and traders. There's been times where having these exchange traded markets meant a lot, and some exchanges are sketchy, and not just the LME, but I think there's a lot of over-the-counter exotic stuff that they're doing with counterparties, um, and I don't agree that using my type of system, one entry, one exit, and a stop loss, that I don't think the 2.0 Sharp is real, because Sharp's not real. Okay, it's not real in the sense that it doesn't do a good job of filtering down to the reality of what risk really is. Obviously we've seen that historically. High Sharp ratios. There's a quote out there from Taleb or someone saying a high Sharp ratio is correlated to losing all your money, basically, long-term capital. So I don't, with my systems, I agree with Bruno, that all the markets have about the same expectation. And it's not only that they do, you have to assume that they do in order to build that sample size when you do that back test. And so all markets, if their expectation is lower than the group or higher than the group, they're moving towards the group all the time as history unfolds. In 1,000 or 2,000 years, if we still have all this data going back to the 1970s, then the evidence of all the markets that have been around for 1,000 years is it'll be almost impossible to find any market that doesn't have that average expectation, unless the market's trend following doesn't work any longer, something like that. Okay, I digress. But he did sort of slip up a little bit and say that they traded sunflower seeds. So that is South Africa. And a lot of people trade sunflower seeds. So he's defined alternative. Like, he's made a point that we don't trade U.S. markets, we don't trade European markets. The exchange traded normal markets, we took them out. It's like this slap in the face. Not only do I trade 500, not only do I trade the esoteric alternative markets that you don't know anything about, that it takes a lot of work to set up, which I'm applaud and I'm jealous of, but I don't even trade the ones you trade. So we're like, whoa. And that could be 600, 700 markets now. And he's promising to add 50 per year. So they have a game plan to continue to uncover. It sounds like it's just a question of doing the paperwork and setting up the administration, which, trust me, setting up an FX account to trade the euro and the pound takes 4 to 6 weeks. Okay. In the US. So anyways, he's lumping in those sunflower seeds in South Africa that a lot of people trade. So here's his own definition. He's the one who's defining alternative, and I would say that that's not so alternative, but it really is a little bit of performance and a lot of marketing, in my opinion, because once again, for me, if you're going to trade vol management, correlation management, and not one entry, one exit, and one stop loss, then I can't really evaluate that Sharp or that your talent. I don't know what I don't accept those measurements. I don't accept that strategy. I don't accept Sharp. So I can't really say too much.
But it would be nice to have a back test. In this group, it would be nice to hear, someone actually, purchasing the data and testing it. I would be interested to hear the back test results in the future. Thank you.
If you asked a question, I wasn't able to hear it. Sorry.
Jerry, was David Drews ever a mentor of yours, and how in the world do you think he did it without stocks, or do you have any idea?
Well, no, I never met him. I maybe exchanged an email or two with him, primarily because I was a long time ago when I first heard about him. I was exploring investing in his fund, but I never really spoke to him. And I think my friend Mike Melicinos, he actually talked to him, and they had some conversations, let's say. Now, when you talk about adding stocks, and he a good idea. It's just going to make your performance worse. And so maybe you're sacrificing your own personal performance and wealth for this crazy crisis alpha, again, junk. But maybe also that when you talk about trading stocks, you're talking about trading stock indices, which they kind of suck too. So maybe he's like, well, why trade them since I'm going to trade indices and they're not very good trenders. You don't have really great outliers. Or he just sort of succumbed to this CTAs have their place, and it is basically fitting into a small allocation to traditional portfolio. So I'm against all of that. And oh yeah. So what I wanted to say was he had one quote on there that I thought was absolutely brilliant. And I don't think I fully understood it, and I think there's more than one way to interpret it. But it was something along the lines of you can tell if a system is robust if it's very volatile. And I probably heard that 20, 30 years ago, read it. It's on its website still, I believe. And maybe I butchered that a little bit. But I took it to mean that you have these loose pants. You don't have extra rules to stop this volatility. Essentially, vol management just stops it. I don't like it, let's stop it. And you know what? It's a rule. That's the problem. Bullshit rules. Too many rules. Too much optimization. I don't like it, let's do a rule. Back in the day when I sat in front of the quote machine with the commodity perspective charts, if I got out of the trade prematurely, it was violating the rules. Now, if you just write that rule in there, you just see something you don't like, tighten up your vol and correlation management, you're done. And you can just call it a rule, and that's essentially what happens. So this loose pants, this no extra rules to limit volatility, limiting your losses is the money management, along with the diversification in the longs and shorts. And so yes, if you're doing that correctly, and that's going to maximize your robustness because you only have those three rules, basically entry, exit, stop loss, then you're going to see some volatility. And so I thought that was absolutely brilliant that he said that back in the day. And so now I want to move the ball forward with not only that, but if you're going to believe that, honestly, let's just want to be honest with myself. If you're going to believe that to be true, that trend following doesn't need to add extra rules, the risk management is built in with the stop losses and the diversification and the shorts, then and you want to let those profits run, and the most important thing to you every single day is to treat each individual trade the way it's supposed to be treated with those rules, then you cannot really be serious about drawdown that's going to come from a bunch of hugely winning trades. So, and then Mulvaney, who we're all love and really think he's the greatest, he's going to have this big drawdown, but after how much profit, for God's sakes, right? And I posted his performance in a tweet. Oh yeah, it was about drawdown, and I was trying to sort of talk about how drawdown was sort of irrelevant, especially after long winning periods. These type of trend following systems, they tend to be very reliable. They make money. The trailing 12-month return is 90% profitable, or it's way up there profitable, and they're very consistent, making money over long periods of time, over a year or two. They have a hard time being negative. And the drawdowns, should come, the bigger ones, after you've made a lot of money. And so I included in my tweet or response his track record. And just look at that track record, since 2019, and you're like, what kind of drawdown, what if you would have liquidated or redeemed from him, or criticized him, you know, before, now what, how silly was all of that? What kind of drawdown would you accept to make like 200% in 3 years? Or I think it's probably even more than that. But and you have to just ask yourself, maybe you're the one who's wrong in nitpicking on these little ups and downs that would prevent you from fully maximizing his strategy. And so I think drawdowns. Now, if you can definitely get into a situation where you have lots of losing trades in a row and you're eating away at your capital base. That's entirely different. You just have to look at these performances a little bit closer than just these traditional reward risk measurements.
And sometimes, Jerry, it comes to the point that even you, I don't know what you think about this, even you understand it fast or not. I mean, you can invest in Mulvaney because you just get it for the first time, you understand trend following, etc. Or you're not sure, and you wait, and you wait, and then you got the huge drawdown when you get inside the fund. And sometimes it's an issue, you either get it or not. And I was thinking about something that Mike Harris said this week about quant, and he said that people who are not used to think like quants, and they are in their 40s or their 50s, they shouldn't try to get into quant because it requires a life experience of thinking about these problems and having the experience, etc. Do you think the same about trend following? Do you think that if you don't get it the first time, it's better not to get into it because you won't get it, like some people in the value camp say?
Well, I read that a bit, maybe a little differently than you just described it. Maybe I don't remember it clearly, but I remember reading that, and I think he was talking specifically about technical analysis.
Yeah, about TA, yeah.
Right. So, okay.
Coming from TA to quant.
Okay. Well, yeah. I mean, that's probably true. But I don't like TA. I don't think TA is good experience. So that's going from zero to quant, or you're doing things you shouldn't do going to quant. I'm not a TA fan. TA, strictly speaking, I think it could be semantics for some people. But look, what we're into is systematic trend, rules-based, entry, exit, stop loss, do the back test, look at the results, not charts and pennants and flags. Oh, yeah, and double tops. I looked at that one tweet, and it was something about we're in a double top in some sort of market. I think that's what they call it, a double top. And so I looked at that chart, and I was like, oh, yeah, I think that I would rather buy that double top because it's like a breakout. And so then it has to fail by a bit. Well, it's so close to the high. I mean, the expectation is still great on that trade. I want to buy it or stay long until my stop loss got hit. So this sort of pattern recognition without the back test is to be avoided. And so you're not qualified to do anything if you're not running a back test and just looking for. And I think what he was saying was, well, and then someone else chimed in too. And I think what they're kind of saying is, yeah, TA is a little sketchy, but people use it. It gives them confidence. They've had experience. It's more than just the TA part. It's the TA plus what it makes you feel good. It helps you trade. You kind of know when to use it, when not to use it. All this discretion and subjectivity. Subjectivity, I'm not a fan of course. So I don't really. I think trend following, on the other hand, you can be 99 years old, right? Start today. Start as quickly as possible.
Hey guys, hey everybody. Yeah, this it's just I had a comment about TA. It just occurred to me how I could describe it. I always understood technical analysis as as the quantitative analysis for people who can't program. So TAs, technical analysts, are quants that can't backtest. And quants are technical analysts that can backtest. So one can be defined with the other only in terms of the ability for you to code and backtest. And this is why technical analysis has kind of a astrology, kind of a quacky sense in the investment community, because so people, first of all, people who can't backtest, whether they are technical analysts or fundamentalists or whatever, people who can't backtest can only depend on books and rules of thumb or wisdoms that they can hear on spaces from Jerry or from Paul Tudor Jones or Soros or from books, and then they hope, okay, these guys know what they're doing. They probably have some statistical significance in what they're saying. There must be an edge in what they're saying, but they have no way of checking it. So for me, this was maybe, I don't know, 30 years ago. I don't want to disclose how old I am. The most fundamental part of me, even if I was going to go into investing or into a field, was the ability to code and backtest. Because one, just from game theoretical standpoint, I could not hope that somebody is going to give me the nuggets or the holy grail in a book or in spaces or because they love me. So they're going to say, okay, you don't need to test anything. I've done it all. I've tested it all. And you just do this and you're just going to do well. I knew that, I don't know, it would not make sense. If it was worth it, why really share it? And then if you share it, it's probably not worth it. And the only way for me to separate or distinguish or to begin to trust information that I'm getting from books or from smart people or experienced traders or whatever is the ability for me to confirm it on my own. If I cannot confirm it on my own, it's worthless. And so this is where the technical analysis comes in. I mean, 99% of technical analysts can't code and cannot backtest. And they have these rules about patterns or setups, or if there's a double top, it's more likely to go down than up, or if it's a base, it's more likely to break out or not, or what, more likely by how much? Is there an edge there? Even if there was a statistical edge, can you cover transaction costs? And at what time frames? If you're doing 5-minute bars double tops, or if you're doing daily bars double tops, and all these things. So chartists, when they see a chart and say there's something more likely to happen after this happens, which is what technical analysis basically is. Divergence, convergence, MACD. They have no way of verifying the statistics. They have no way of verifying or even producing or giving what's the statistical edge is in that statement. And that's what technical analysis is quacky.
And do you think you can transition from TA to something more like a quant or a verifying way of doing things?
Well, so this is the thing. If somebody has spent too long of a time as a technical analyst, that's evidence that he could not program and he could not backtest. Otherwise, he would not be a technical analyst that long. So basically, your answer to that is that if you can learn how to code and how to backtest, you would do it as soon as possible, at which point you stop being a technical analyst. You become a quant.
Well, I think that I see where I kind of agree, but there are exceptions. Some people can hire people to do that, backtest. And
by all means, yes. I agree. Yeah.
And then some people, I mean, come on, you can't rule out the possibility that some people just prefer technical analysis and they can code, but they're like, no, I just see that there could be patterns and I've worked with it. I had a mentor who told me about this and I want to keep doing it. I think it also highlights another thing to keep in mind, that we need to be systematic trading we need to be systematic traders first and foremost who do back test, and then whatever the computer, and hopefully we have some knowledge and some creativity, and we are trying to push boundaries, and then we come back with a good strategy, and then we use words like trend following and trends and let profits run, take small losses. It's just ways to shortcut explaining this back test. So we're systematic first and foremost, and we're going to go where those numbers take us. But we use the other words, cliches, and and that's the problem. Is they mean different things to different people. You can not on purpose. You can on purpose trade fewer markets. You can on purpose get out of a trade before the trend ends. You can get based on vol or based on excess correlation. You can do all of these things on purpose, and they will still call themselves trend following, and they'll still say they let profits run. So this is why the word part of all of this is it's less precise, and it's marketing to some degree. And but the trend. I'm not a big fan of any of those things except these systems and doing those trades based upon the systems in the exact way that you should. And oh yeah, by the way, it happens to look like following trends, using price only, letting profits run, taking small losses tends to be elements of successful trading or backtest.
Jerry, yes, I was gonna say that. It doesn't mean that you personally have to be able to code, but yeah, if you can hire people to do that, but you basically want that confirmed by coding and a backtest in one way or another. And I'm sure the big part of the confidence in what you're doing comes from the researchers and tests that your guys have done, where the 40% win rate and 3-to-1 win ratio gets confirmed all the time. If you cannot confirm that, if you don't have those numbers in the back of your head as a statistical edge, you wouldn't be doing what you're doing. And I think a lot of technical analyst people don't have that. When somebody is doing a double top or a MACD convergence or divergence, they don't have the 40% success rate and 3-to-1 win ratio in their head because they have never done it. That was my point.
Right, you got to do that stuff. I was limited on what I wanted to do, and I was just going to do trend following and make it better. And but I think I was mistaken in that we were sort of taught to be systematic and and abandoning trend was perfectly fine. I think in some respects, I stayed closer to the original strategy, you could say, because all I did was move out the look back. Okay. And then I think that some people would say, oh no, you were the furthest from what we did because you moved this look back out so far that you're basically more like buy and hold. And we are more similar to what we were taught because we maximized back testing and being systematic, and just because it looks less like trend following that we were sort of taught, it doesn't mean that we weren't kind of closer to that overall philosophy. And I would not necessarily argue about that. It's I was more of I thought we were all learning about trend following, but I think we were mostly learning about systematic trading, and I didn't have a desire. Now, I remember I went and visited David Harding once, and I was in his office. This was a long time ago, I don't know, hard to say, early 2000s, 2010, hard to say how long ago it was, but they were doing pretty well, but not at their peak power. But I went to his office, and he told me that he likes to replicate other managers, so that whenever he hears about another manager, he sets his research team to replication to see what they're doing, see if he can pick up on a good idea or an unexplained element of someone's strategy. And then at that point, even he was really interested in preparing for the need to do things other than trend following. And I was like, oh, no, if trend following stops working, I will just retire, I guess. I don't think I was serious, but because I was pretty sure that it was never going to, in my mind, I was pretty confident it was never going to stop working. But he was like taken aback a bit. Like, what? Why are you saying that? I was a trend follower first, moving out the parameters. Darn right. That's just obvious. Just move them out. The markets are choppier. We need to have looser pants. The long-term stuff worked better when we were using the short-term stuff. We should have never used the short-term stuff. But if it's going to work, you can leverage it up and maybe make 200%. But if you're going to shoot for 20% or 15% a year, you can easily trade longer term and move those parameters, that look back period out, and life is great again and easy. But I think it just depends on where you're coming from. Another edge we had was we were like, the whole group was not very good at doing much in life, except we were willing to learn and follow those rules, and was above average intelligent group. We were willing to follow the rules because we didn't know any better, and we didn't have anything else. We were just accounting and blackjack players, and guys with normal jobs. So we didn't carry in all this baggage of other things. And I think when some of the more famous CTAs, they definitely came with lots more going for them knowledge-wise and math-wise and physics and computers and blah, blah, blah. So trend following kind of got put on, we'll integrate in trend following with what we already know. We didn't have to integrate anything because we didn't know anything other than trend following. So to that degree, I think that there's a big difference there, and it's totally natural for, well, at least one person like me to stick with that strategy, and then totally natural for other people to make trend more of a part of the puzzle, a part of the strategy, and we're not going to turn our back on traditional math and investing.
Yeah, I liked your comment about David Harding and how he was trying to reverse engineer other fund managers. So I can say I've been doing that for 30 years. So as I'm hearing people comment about the strategies, what they're doing, which markets, what time frames, it's so much fun to just go back into your lab, into your database, and just quickly do a prototype to see whether you can match their performance. And that's so exciting, and it doesn't have to be trend following. I was for the I don't know, for the 20 plus years I was trading institutional money. I was also trading statistical arbitrage, mean reversion stocks. Um, so basically, it's called statistical arbitrage, and that was a great pair to do a trend following system. So basically, one is convergent, one is divergent, and as a combination. So if I am religious about something, it's about systematic trading. But there's many ways to skin this cat. There's many successful funds, multi-decade funds who are doing trend following, but also many other things. And most of the places, which are the multi-strategy funds and most prop desks in banks, they are basically like casinos. They just vacuum up alpha wherever they can find it. They have teams constantly reverse engineering other people's ideas and testing them and improving them. And that's how they get to, the Millenniums, the SEC Capitals, and all the prop banks. You'd be amazing if you see their P&L in their book. It's like it's from another world. I mean, they're approaching sharp 4. I know you don't like sharp, but it's pretty much like a straight line.
Yeah, I don't like sharp for what I do, but I can definitely see another universe that I don't fully understand. It could be great. Oh, did you see that article? I posted it earlier this week about Virtu, which
Oh
has,
yes, yes, yes.
which has, yeah. So I actually also met the founder of that firm when he was the chairman of the New York Board of Trade, or it's in the article what he was chairman of, one of the exchanges, and had a chance to meet with him long time ago. But let's see, what I found funny about that is that we've heard these stories before about these type of firms that have one losing day ever or something like that, and then um, that was just sort of a glitch, kind of a glitch. But thought two things popped out. One was that they they make markets in like thousands of markets, right? So where are these thousands of markets, and why can't we trade them? And well, maybe it's ETFs and things, which we don't want to trade ETFs. If we can get at the underlying, we don't want to trade diversified ETFs. But maybe that's what they're doing, in some of the. But anyways, the funny thing is, Virtu was in my at one point recently. It was in my group of stocks that I traded, my fixed universe. I dumped Virtu. Um, And okay, this is what I couldn't reconcile. And I didn't really know about this article. I guess I'd sort of forgotten. I wanted Virtu in my portfolio because it's weird, right? Uh, it's diversifying, right? By nature, no one is. I don't know of any other stocks like that where you can participate in that kind of income flow. Like every day is a winning day. So at one point, I wanted them in there, and they were very diversifying. However, I think I was long once for two, but mostly I was short. And so when we were setting up our ETF, this is really inside baseball. We have to find a lead market maker, and I think they interviewed Virtu, or we tried to get Virtu to be, to see if they wanted to be our lead market maker, and they were like, no, we don't. And I was thinking, well, if they said yes, I'd have to get rid of that short, of course. But I found it very odd that how can you have a firm that kind of prints money, and yet I'm short more than I'm long this stock. So shorts are fine, shorts are great, but I just couldn't figure that part out. Anyways, I changed my philosophy on having them in the portfolio, and but I haven't checked the chart recently.
That's because stocks are forward-looking, Jerry. I mean, I haven't looked at the stock, but if their P/E ratio is like otherworldly, because everybody's already piled in because they're so good, then it may not be a valuable place to put your money as an equity holder. But so the guys who were the original owners before they went public, so they may be rich now, and they're now selling shares to other people who are the bag holders for later. So basically, if the proper value of that stock is, I don't know, $10, but the stock is sharing at $200, now the owners who think it's overvalued, because in order for the company to be worth $200, it not only has to make money every day, but it has to make 10 times the money every day. And that's probably impossible, because when you're doing high frequency, there's capacity limitations. So you can have a perfect company, perfect business, whose share price may not reflect the consistency of its income and the consistency of the business, because it's just so overvalued.
Well, I'm sort of trying to keep it going. Oh, I wanted to look at the article real quickly, because one of the things I remember in the article was them saying, well, the stock price isn't doing very well because people don't understand what we do. So it was kind of like we should be higher, but yeah, it's in the article somewhere. I can't find it, but yeah, I think that's what he was saying.
Well, he may also. There's another thing also. There's also was a big over the last 10, 15 years, a big debate about whether what these high frequency firms were doing is actually legal, like with their access to the exchanges, where they can actually see bids and offers before they appear on the exchange or not. So microseconds or milliseconds count. So basically, you're paying for order flow. So there's always the regulatory risk or criminal risk, where if it gets established that they're doing something illegal or something that's not allowed by law, or the regulators don't like it, that stock's going to zero. So that's another risk for why those shares are behaving the way they are.
All right, pretty good. I'm going to move on to my next thing here. I almost made it to 2 hours. It's not too bad. So, yeah, I think we'll be back to the regular time. Let's see here. Yes, regular time next week, 7 a.m. Eastern, 25th. I'll put that out there. We'll be back at our regular time, hopefully with Richard and Moritz. Where the heck is Moritz? I'm a very big user of the calendar, you know, and so I have my whole life is chronicled on my Google Calendar, and I invited Richard and Moritz to my trend following spaces on my calendar, and but they're not calendar people. Okay, no problem. But
Jerry, you know there is a saying: if you have a watch and use a calendar, you're not rich.
that's right. Well, you don't act rich, that's for sure. If you have a calendar, I have a lot of watches. I love my Apple Watch. I got the big one, the new one, and I may have mentioned this before, but I went to see Beyonce a few weeks ago in New York City, and my Apple Watch was telling me that I was in a dangerous zone of the decibels were too high. My chest was like pounding, my body was pounding and shaking, and my watch was telling me to get out of there, but I didn't take it seriously. So I have a lot of watches. I like my Apple Watch. And yep, and a calendar. Oh my gosh! So like if you look back, if when my wife looks at my calendar after I pass away, she'll be able to create a very good timeline of everything that I was up to when, because everything is chronicled right in my calendar. Yep. Okay, everybody have a good weekend. We'll see you next week. Bye.